Hi, and welcome back to Hedge Fund Manager. I'm Karl-Mikael Syding, and we're doing a deep dive into LVMH. And we've come to the ranking and portfolio design phase in the deep dive. So what we have done now, we have estimated the risk of LVMH, we have estimated the total annual return, and we've come up with a ratio, a risk-reward ratio of 1.8, and by definition the market is at 1.0, and 1.8 is a very good risk-return ratio. However, keep in mind that we still have pretty strong fundamental headwinds and technical headwinds in just looking at the chart, the price trend, the negative chart price trend, both for the market and for LVMH in particular. And that means that it is more likely than not to become even cheaper, even though that is not really warranted. But as risk aversion takes hold, as liquidity flows start or keep being negative out of the company and into other perceived safer havens, we're likely to see even cheaper levels, and we should hope for that. But already at this point, I can tell that this one is ranking very well and actually should be added, at least starting to accumulate in your portfolio. Maybe buying already now at the weakness of the Q1 earnings, already now buying 10% of your desired future total position, just to make sure that you're actually not missing out on the action, because we don't know when the stock will turn. We don't know when other value investors will start piling in in earnest, and we don't know, and not the least, we don't know when the stimulus faucets, the stimulus taps will just be open full on in terms of quantitative easing and stimulus like that. Although my best guess is that it will take at least half a year before we get there. We would need to probably see some freezing up in the bond market before we can hope for that type of a tailwind in terms of capital flows, money printing, and less risk aversion and more greed and FOMO taking hold again. So we're likely in for quite a bit of more negativity before it's really time. But that doesn't mean that this is not already tremendous value. And remember, there were a lot of people buying this at 750, and it's now at 495. And at 750, people were like screaming that this is the only place in town to be in terms of luxury and retail. And it probably was okay value even at that level, although it didn't leave much room for a margin of safety for bad luck and negative sentiment. So what we're doing is that we are now want to rank this company compared to both to the market and also to all our other alternatives. But at this point, we don't really have a list of CAGRs and risk assessments, although we could more subjectively and intuitively rank, for example, Google and Meta and Nvidia and the others just based on other people's estimates. So we just take a list of, for example, their price earnings ratios. Like, for example, here we have my list of all the most wonderful companies in the world, and this is definitely not a recommended way of doing your ranking, but if we just rank it from low price earnings ratios, and we can see here you have Volvo at 3, Traton at 6, you have companies like Kaspi at 9, although these numbers, since they are not controlled by us, we can't be sure of how the forecasts are made, how robust these estimates are. I would actually say that Kaspi is trading at quite a bit lower price earnings ratio than 9. So Kaspi would actually be my absolute best recommendation at this point in mid-April 2025. So it's already extremely cheap, but even that one might actually get even cheaper, despite this very low price earnings multiple. So, and anyway, in a comparison with LVMH, this Kaspi might be kind of a harbinger of how low LVMH valuation could get to if the negative trends persist and risk aversion takes hold. We have Conoco at 11 times. So as you can see, there are lots of great companies here being traded at much lower multiples than even LVMH. Elekta is another favorite of mine, and Elekta, it might look a bit expensive here at 17, but I consider this a takeover candidate, and in many ways it should actually be trading at twice today's share price. But we'll talk about Elekta in a later stage, and then we end up here with Louis Vuitton, pretty far down in terms of how expensive they are, although there are lots of wonderful companies that are still quite a bit more expensive. Meta is almost at the same price earnings level as LVMH. Apple is extremely expensive, one of the most expensive stocks in the stock universe. In any way, in this ranking, I would say that we have a pretty average ranking for LVMH, and considering our environment, we should actually expect it to become cheaper. Right now it's fairly too attractively valued, but we want it to be really cheap in order to pour in our investments there. So in terms of ranking, it's okay, but it's not probably should not be considered our best idea. Then we're talking about portfolio design. So how much should be allocated to each idea? I would say that a really good start is to put 10% each in 10 good ideas, because at this point we are not as skilled as being able to make a really lopsided portfolio with 20, 30 or 40% in our top idea and just a few percent in our worst idea. Actually, the worst idea should be absolutely at least 5%. Otherwise, it doesn't even belong in the portfolio. And I think around 10 stocks is a good place to aim. But maybe from 20 to 5% from top to bottom if you're a bit more skilled and you actually know which companies you know better and that have a better risk-adjusted return. On top of this, we should also make some macro considerations, but these are only relevant when they are really extreme. So I will actually more or less skip this entire area right now, but it suffice to say that you should look at all the things that are driving sales and profit margins, and there are some key indicators in terms of leading economic indicators, ISM and PMI numbers, although all of these are very unreliable. The things that I consider most reliable in terms of macro environment is actually the valuation. Well, also bank lending standards, but that is a bit esoteric for any type of beginner to start analyzing and understand. So instead, I would rather recommend to go straight to overall market valuation environment. And right now you can see it is in the absolute extreme, and it should be considered a huge headwind, because if markets start moving downward, then this leaves no margin of safety and leaves no room for value players to come in and buy in earnest. But on the other hand, you can see we have moved from very, very low valuation to an extremely high valuation, far beyond what could be considered plausible. So if we can move like this, maybe we can move even higher in anticipation of more money printing. And now the final thing that we should do is get a complete overview and perhaps also a pitch and a presentation of our idea.